Hey traders, today is Monday, March 2nd, and I'm Michael Boutros, Senior Market Analyst with StoneX here for a quick multi-time frame look at the US dollar. So the headlines are hitting fast and furious ever since news of the war breaking out in Iran. You've seen the US dollar on the Sunday open break higher. That rally is now approaching some critical zones of resistance that could turn the tide for the US dollar here on the medium term. The objective level we're looking at on the weekly chart here is the 618 retracement of the decline off the November highs. Just a bit higher is the 52-week yearly moving average. That gives you 98.55 into 98.94. We're basically looking for a reaction there this week. Ultimately, we would need to see a weekly close above this moving average to suggest that a more important low is intact and a larger trend reversal is underway. Looking at the daily chart looks a little bit clearer. You can see this is the largest single day advance that we've seen since late January, and momentum is now approaching the highest levels since the start of the year. On the near term, 98.55 into 98.69 being tested right now. Again, that's that 618. You're also looking at the August high day reversal close as well as the May lows. So a key pivot in price converging on downtrend resistance over the next few days. This break is going to be critical. Just higher, where that 52-week moving average is also the 100% extension off the low. And that's the level, if broken, would really suggest that there's a larger shift in trend here to the upside in the DXY. Drilling down even deeper, here's the 4-hour chart. Again, momentum here breaking into overbought conditions for the first time in a few months. And the focus is on where we close with regards to this key zone. The 100% extension converges on uptrend resistance basically tomorrow and Wednesday. If we break that, the focus does put the bulls in charge towards a rally towards 99.35 into 99.37. That's the 786 retracement of the decline and the objective 2026 high day close. You can see that the February opening range was intact all the way into the close of the month. This break does give us a shift in bias to the upside after clearing that range and keeps the trade constructive. Now, near term, look at the 200-day moving average for support that comes in right around 98.35, converges on the median line over the next few days. That's initial support backed by the yearly open. Bullish inval is still going to be at the breakout zone of that level we were tracking all last month. You're looking at 97.97, 97.99, basically 98 proper. That's the 618 extension from the advance off the lows, and that's the 50% retracement of the decline off the November highs. So that's the level that needs to hold if DXY is heading higher. The level that which would put the bears in control would be just lower. A break of the objective monthly open just from yesterday gives you 97.86. If we were to break below that level, it would suggest that a more important high is registered, a blow-off exhaustion high, and the potential for some dollar weakness. All things held constant, we're constructive above 98. We're testing resistance today, right now, at 98.68. So look for a reaction here into the close of the day. We need a daily close above to continue favoring the immediate upside. Now, the implications for this war drill down more deeper even than oil. Obviously, oil is seeing a massive rally in price, but the implications are for what this means for Fed policy. If oil prices maintain this thrust, and certainly we are at nominal resistance right now, just below it near 71.90s. You're talking about the August low day close, as well as the objective yearly open from last year near 71.90s, basically into the 72 handle. If price stays at these elevated levels, that could bleed into the inflationary outlook. And with non-farm payrolls on Friday, it's going to be critical, the close of this week, how this pans out. Non-farm payrolls are expected to show a print of 60,000. If we get an expectations print or better, that's going to continue to weigh on expectations for further Fed easing. As it stands right now, the June rate cut, which was widely expected until last week, is now just below 50%. 52% is being priced in as the probability that we'll see them actually hold in June, which pushes the next rate cut out into July. And again, if we look at the Fed dual mandate, if the labor markets continue to hold their own, and we see that the elevated oil prices are likely to affect the inflationary outlook, that might make them less probable, less comfortable less willing to cut rates as often as the markets are pricing in, specifically here now starting in July. So the Friday rate or the Friday NFP decision will be critical. From the DXY standpoint, watch this resistance zone today. The headlines are going to continue to filter through. We'll try to keep you updated at MB Forex as always. Till then, best of luck trading, and we'll see you tomorrow. Cheers.